Earlier this month, our investors and I had a chance to talk with Sir Martin Sorrell of S4 Capital. I was asking him about his management style when the conversation took an unexpected and sort of philosophical shift into the merger of ownership and management. So I've put together some of my favorite comments from this conversation as it relates to this topic, and I hope you enjoy the following part of the conversation we had with Sir Martin Sorrell.
I mean, just one little aside. There's this great Israeli professor, Aziz. I think you can get his films. I think it's Aziz or Aziz. You can get his films on YouTube. And he sent me, or I looked at one that he talked about. This is really interesting, I think. The difference between old and young people. Old people have wisdom, young people have intelligence. And he said at the end of the day, the best mix you can have, you have intelligent people in your organization, you have people with wisdom, older people running them. So I thought that was a very good way of putting it.
Well, it's funny because in the research note I put out to our investors, I framed the investment in S4 as a very rare combination of sort of the wisdom of your career with a small package in a young group of people. And it's, I mean, Buffett talks about it all the time. If he could start over with a clean sheet of paper and a smaller balance sheet, he could absolutely crush his current performance. And so you sort of get that with S4, right?
To be honest, it's the law of big numbers, isn't it? I mean, we say that the agency holdco models are past their sell-by dates. What we're saying actually is that they've probably got too big. And, it's a bit like, dare I say it, a GE after Jack Welch.
Yeah.
When I was at business school in 1966 to 8, a long time ago, there was Jimmy Ling of Ling Temco Vought, and then Hal Janine of IT&T. Hal Janine ran a conglomerate, and after him they disassembled it. And it is a bit, it's these companies do. McKinsey say the average life of a company on the FTSE 100 or the S&P 500 about 17 years. The average life of a CEO of what I call a managed company, that's where you have a split between ownership and control, is about 5 years. So these things have finite lives in a way. And I think it is the law of big numbers. And, obviously I was sad about what happened at WPP a couple of years ago, but with 2020 hindsight, maybe it was for the best thing. And as I've said on many occasions, we have a point to prove. I mean, there are business history is littered with people who left a company and then started again and did as well, if not better, by so doing. So we'll see how it all works out. We're only in the first act or the second or third innings of a 9 innings game. So to use a baseball analogy, or the first inning. The first innings of a test match, if you know what a test match is, Stephen.
I'll stick with the second or third inning, but I'm actually surprised to hear you say that, because I think it's kind of the first inning right now. I mean, the market cap would suggest you're in inning 2 or 3.
Well, I mean, we have a long way. I mean, I look at this, I'm 75, so I have a finite life. And, we have a very good team. We have 8 people. I just came off a call where we had our daily call. We meet. That was largely driven by COVID to some extent, but we now do it. It's a permanent sort of institution. We meet every day. We talk about people because of COVID, obviously, and cases and infections and their families, etc. And then we talk about clients and we talk about our finances. But it's brought the management team together. It's a very strong management team, as good as anything I've ever seen at Saatchi's or WPP. And, I think actually our bandwidth is quite strong and wide. And I think we have bandwidth to do even more. And I think we'll see how it goes. But I would say we're probably in the sort of second inning. I've said that to investors, you look at the original prospectus, I have a first run of 5 to 7 years, and then if I'm healthy and people want to keep me involved, and I've got the energy, which I think I have, but at the moment anyway, I'll do another 5 to 7. So, I'll do a 10 to 14. You mentioned Buffett at the beginning. I think Warren is 89?
I think in Munger's 95, I believe. And there's
Munger is 95. I mean, Munger is amazing. I mean, his brain.
He's sharp. He's just as sharp as ever. It's amazing.
Absolutely. Incredible.
But this is good. This goes back to a question that we kept getting, is where do you get the energy? Where do you get your energy?
No, it's from my mother's genes. You know, they say my mother died. We buried her on 90th birthday, and her mother, my bubba, as we call her in Yiddish, lived to a ripe old age, and so I think it's my mother's genes. But the other part of it is I didn't want, or two parts to it. I didn't want to retire. I don't like the idea of portfolio stuff. Private equity, I like in a sense, but I find it too short. Their timeframes are 5 years. They're almost plotting the exit before they've made the entry. And I find that my father said, he believed in long-term branding. He believed, you should stick with the same firm that you've been, as he did all his life. He said to me, find an industry you like, find a company within the industry it's finding you like as well, build a reputation. And if you feel like starting on your own when you're 40 or so, maybe I started a little bit too late. Maybe I should have done it at 35. Maybe not, but I think maybe there's an argument for that. But then build a reputation. If you want to do something on your own, go off and do it on your own. But my father was about long-term brand building, and I agree with him. He also said, he said, portfolio investment is a mug's game. Invest in the company you know best, which is the company in which you work, which is totally counter to all the wise investment advice about that don't have your pension and your job in the same company. So he was counterintuitive to today's climate where you flip from flower to flower. But, I think there is something in what he said, and that's what I'm interested in doing. So I think I probably have a 10 to 14 year run on this, and the team is really strong, and there are plenty of people out of that 8 people who could run the company, and they're really good.
So 2 follow-ups with that. Are you having fun? Because one of the gentlemen on this call says when he sees you walking around in Mayfair, you don't look so happy when you might be rushing from meeting to meeting. I'm not sure. And then the second thing is, when you put all your eggs in this one basket, it seems to me the way that you talk about your clients, Google, Facebook, Netflix, it seems to me that you're putting all your eggs in the S4 basket, but then you're getting your exposure to companies based on where you would want your investment portfolio invested, right? Because you referred to where the growth is coming from, IT and healthcare companies. Is that a right suspicion?
Well, on the looking happy, I'm a restless soul. So if he sees me scowling, if that's what he or she says, next time I'll smile. But my father always said, beware of smilers, that he always said, beware of people who have a permanent grin on their face. Listen, I'm a restless soul, and this is part of the formula. I mean, like Buffett, if I can draw that analogy, I believe that giving management options on shares, as Buffett said many years ago, you wouldn't give an institution option on a share for 10 years at zero cost. So why would you do it with management through options? Restricted stock with performance, or putting your own, nothing beats putting your own money where your mouth is. And I believe, coming back to the looking restless or unhappy or whatever, I believe that every morning you get up, you should have your heart in your mouth, as I put it, which means you should be restless about it. I think what people miss, I always remember, there's criticism when I was at WPP of my compensation. Always, everybody failed to point out that I put money in. And actually, it's a very interesting, maybe it's it's not a diversion. So Lionel Barber, bless him, the former editor of the Financial Times, wrote an editorial, and I think it was the headline was "The Humbling of Sir Martin." So I rang up Lionel and I said, would you mind if I write an editorial response? And I wrote the headline. I asked Lionel to put the headline, if I could write the headline. He said, no, you write the article, not the headline. But the headline turned out to be something along the lines of, I'm an owner and I act like one. And guess who rings up as a result of that article, but namely Warren Buffett. And he made an offer. Sadly, because I really wanted to do it, the premium was not enough. Our investment banker, probably the best investment bank in the world, said the premium wasn't enough. It was about 25% of the price.
Okay.
It was about 925p actually, which is much higher than it is now. And the listed company premium was about 30%, which was 1,000p. And I always remember the bankers got on the phone with Buffett and said, now, if you define fixed cash flow, and his formula was 13 times fixed cash flow. If you define fixed cash flow in a slightly different way, you get to 1,000, right? And Warren, this is an immortal line, turned around and said, I think I'd been long enough in this business to know what the right definition of fixed cash flow was. So look, I just believe that, coming back to the restless thing, Jorge Lehman said, didn't believe in corporate governance once at a conference that I was at. He believed in management having a significant stake. And I think the problems occur when you get a split in ownership and control. Look at WPP today. The management and the board have nothing, zero. I mean, it's a rounding error of stock in the company.
A lot of our pain.
I'm not saying it's all driven by financial criteria. It's driven by desire. I mean, it might be our mission statement: create new age, new era advertising and marketing service model. But the financial structure has to reinforce the qualitative objective.
We've gotten into a lot of mistakes. I think a lot of investors pay attention to the management and the skin in the game, but some of our most disastrous mistakes have come when the board actually doesn't have any skin in the game, and this sort of the oversight is sort of just best practices. What a consultant would have you.
Do. Under UK practice, if a non-executive director has stock, he's regarded as not being independent, which is
exactly.
I mean, I do think controlled structures. We're a controlled structure at S4. We're a standard listing because I have a control share, and if we went to a premium listing, at least under current listing rules or legislation or whatever, we wouldn't get a premium listing. But we decided that is the best route. So the Hut Group, which is somewhat more controversial for various reasons, but the Hut Group is another good example. They're in the FTSE 100. We're about a number 141, 2, 3 at the moment. We have a shot of becoming a FTSE 100 company if we continue to do the right things and run the business in the right way. But with the control share, I'm taking decisions in the long-term interest of the company. So the mission is build the new age, new era advertising and marketing services model. And the subsidiary mission is to disintermediate, disrupt the old models, which we think the ad hoc companies, ad holdcos, we think are no longer fit for purpose and past their sell-by date. So there is a missionary. This is really important. I think, and if I think about the conversation I had with Buffett many years ago, he runs his businesses like that. You asked me at the beginning, and I wouldn't, Buffett doesn't tend to have quotes unquote creative businesses in the narrow sense of the word creative. He has very creative people working for him, but in much broader definition. He gives them the freedom to operate. He has a structure, a professional and financial structure that enables them to flower and develop, whether it's a furniture company, a jewelry company, a See's Candy, or whatever it happens to be. Brooks Sports, whatever, he gives them the freedom. I genuinely gives them the freedom, no BS, to flower. Slightly different model to ours because we're very involved on the client side and the strategic side. Probably Buffett's is more a private equity type model, but in any event, those are some of the things that I think are important.
We had a number of questions with this unitary. I think the unitary structure is so crucial, and I tested you on it a couple of weeks ago when I asked you about if you're going to do something sort of transformational. Your stock's at 530 now. It's a very nice currency to do something, but I guess, and you sort of talked that down, and you said the unitary structure is key. We had a great question come in. And it was basically, how you're about to do this unitary brand structure How do you actually, how does that impact the founders of Mighty Hive, Media Monks, and all of these, Orca Pacific, all of these people that are joining
Yeah.
you?
Well,
And
yeah.
what does S4 mean? What does S4 Capital mean?
Usually, most people say that's a good question, where they think tough and they want a bit of time to think. So I would say that's a fundamental question. No, it's a really, really fundamental question, because we have basically, so we started off with Media Monks, two very strong entrepreneurs, Victor Knapp, Wesley Tahar, and then we quickly went to, that was on content, and then 6 months later, in December of 2018, with Mighty Hive on data and analytics and digital media. Pete Kim, Chris Martin, both Yahoo, Salesforce, one of their partners, Lexi, the CTO, who came from Salesforce, and Chris and Pete were from Yahoo, and Pete went to Google after that. So very, very strong. Then we added 7 units to Media Monks, and by coincidence, 7 units to Mighty Hive. So we have our content practice, and we have our data and analytics and digital media practice, and we brought the two together. And you're exactly right, or your questioner is exactly right, and very perspicacious, because everybody has their loyalties to their brands. Now there's a sort of hierarchy, but by size and success, or I should put it the other way around, success and size, because the more successful are, the larger you get. And there is that issue. Everybody has a loyalty to their brand, and has a liking of their brand, and has a history with their brand. They may have started in a basement, they might have started in a garage, and they feel baby. Emotion. Yeah, exactly right. It's their baby. But when you get a group of people that have a common mission, and it comes back to the mission. And when we talk to merger partners, the first sentence of the conversation, like we've got several conversations going on at the moment, and the first sentence of every one of those conversations, if you want to sell your company, go and talk to Accenture. We're not interested. We're not doing earnouts. We did that. That was right for the market share model, which WPP and Sarches are. I.e., you're in the detergent business of P&G and Unilever. You launch another detergent, it's going to eat into cannibalize your market share, but you do it because you're going to increase your market share as a whole. So it might damage your brand slightly, one of your brands slightly, but you do it to build market share. That's gone. The seamless integration is critically important. And the entrepreneurs that we have to date, and the ones that we have in the future, I mean, if you make the first sentence of the conversation, if you want to sell, go elsewhere, do an earnout. We're looking for the people, we think it's respectable to trade in half of your equity, but roll the other half.
Yep.
And you roll it into our company, and you have our market cap is approaching $4 billion, and half of that market cap is held by the owners. And that's, if it was possible to keep it that way, that's the way I would keep it.
So there you have it from the legend himself. When I first published our research to investors, comparing Buffett's track record with Sir Martin's, I didn't realize that these stories were going to intertwine so much. So for the first time, we're actually making that research publicly available on our page. You can just go to gwinvestors.com/research and see what we had to say a few months ago when we initiated on S4. I hope you've enjoyed this time with Sir Martin, and stay tuned for future updates on S4 Capital. Thanks for joining.